Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time. This week, guys, we're going to talk about moving averages and trend lines. It's something that I haven't used as often or frequently in the past, but I've been using them way more lately, and they've been extremely effective for me. So today I thought, you know what? Let's talk about that, because if it's working well for me, I bet it can work well for you also. All right? So we're going to talk about moving averages and trend lines and the 5 ways and the 5 areas you can use those things. Okay? Very, very important lecture, because a lot of you have an idea of what a trend line or a moving average is, but you probably haven't used it in these 5 ways that I'm about to talk about. All right? If you like these videos, please click that like button, hammer that subscribe button. Come on. You know you're getting your learn on around here. I am Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is the power of moving averages. We're also going to talk a little bit about trend lines as well in here, but the main focus is moving averages and, again, a little bit of trend lines, and really because I've been using them more frequently lately. In the past, as you guys know, I try to keep my charts as clean as possible. I like price, I like volume, and that's pretty much all I use. And for the most part, I think if you're an experienced trader, you can kind of imagine where the moving average and the trend line would be without actually drawing it. However, I think it's always a good idea to draw it or have the moving average on there, so that, 1, you're certain of it, and 2, you can see if your mind is right? If your visualization of the chart is where it's supposed to be. So anyway, I think it'll be a good lecture, and I think you guys will learn a lot. There's a decent amount of slides in this one. They're almost all charts. There's just a few text slides, and it's mostly charts. And we're going to see a lot of support lines, trend lines, and moving averages. But before we do that, we have to talk about when will the insanity stop? Again, I do these guys each week not to harp on people. I do it really as a wake-up call, because sometimes we all forget and sometimes we get ahead of ourselves. And when that happens, well, bad things are possible. So this week's is, they're never fun, and this week's isn't any different than most of them. But it basically says, my life is over. What have I done? All of this was borrowed money with a very high interest rate. I am dead in the water and don't see a way out. These are sad. This person is down 70% in their account. Okay, lost 70% of his borrowed money account, and it says with a very high interest rate. I know it's cliche, and you've heard it before, but guys, don't trade with money you can't afford to lose. Like, if you borrowed money at a high interest rate to do this business, something's wrong, right? Because you don't have the experience and the knowledge. It's unfortunate, it's sad to read these things, but it's like, I know I use the analogy too much and I overdo the analogy, but like, would you go and risk like $10,000 a hole against Tiger Woods or Rory McIlroy or Phil Mickelson or whoever if you've never played golf before? No, you wouldn't do it. And you definitely wouldn't do it if you borrowed that money from Guido at a high interest rate. Right? That's like double insanity. It's bad enough that you're making foolish decisions with money. It's even worse that you're making foolish decisions with someone else's money, basically, because you borrowed that money at a very high interest rate. So now this person is down $20,000, and who knows what the interest rate, but if they say very high, I'm assuming over 20%, maybe credit card level, that's sad. It's just sad. There's nothing else to say about it. I'm not going to spend a long time on it. It's just sad. All right? It's a combination of greed and stupidity mixed together, ego a little bit, sprinkled in there, and this is where you end up. And again, I feel bad for these people. I genuinely feel bad, but the only thing I can say is I hope, while this is a very difficult lesson for this person to learn, I hope it's a lesson well learned. so that they can get out of it, move on, and not do it again and make better decisions in the future. None of us are perfect. We've all done some foolish things in life, some worse than others. The only thing you can do is learn from it. And I'm showing you these things so you guys can learn from other people's mistakes so you won't put yourselves in this position. All right? So let's move along. All right. So today's topic, moving averages. As I've said a minute ago, I'm not the world's biggest proponent of messy charts and moving averages. And you can see that here in general, here at Live Traders, we're not big proponents of indicators, as there's hundreds of them. There really are hundreds of them. Price and volume are our main focal points. And that's not going to change even after today's lecture, right? Price and volume are still the main focal points. But within price and volume, there's a lot of other things to look at. Double tops, double bottoms, climactic moves, moving averages, bottoming tails, trend lines, right? A lot, volume spikes. I mean, there's a lot of things to look at. Okay, today's will specifically be moving average. They are not support and resistance, right? They're lagging indicators, which means the price has to happen before the indicator can happen. Right, you have to have price action, price and volume happen, and then the indicator can happen. All right, so just keep that in mind. So we're using these as guidelines. We're not using these as de facto support and resistance areas. Right, in professional trading strategy, we have pattern boosters. We're using these as things to help guide you, but they aren't the de facto guide because that's price and volume, okay? They are much more relevant in uptrends and downtrends. It's really hard to read a moving average in a sideways, sloppy, overlapping trend. They don't have as much meaning, so they're far more meaningful in uptrends and downtrends. 4 moving averages that we talk about around here are the 9 MA, 20 MA, 50 MA, and 200 MA. It most of the time just depends on what time frame you're using. If you're on a 1 and 2 minute chart, you might frequently use a 9 MA, right? If you're on a 5 and a 15 minute chart, you're probably going to use the 20 more often. For me, I only use the 50 and the 200. And the reason that I only use the 50 and the 200 is because most of the time, there are exceptions, but most of the time, I am looking at the 60 and the daily with moving averages, and I don't look at the moving average as much on 1 and 2 minute charts. Now, I'm not saying you shouldn't or you can't. I personally just don't do it that much. Unwall does. He looks at the trend line and the moving average on all time frames. For me, I'm mainly focused on the 50 and the 200 on higher time frames like the daily, 60 daily, weekly, etc., and so forth, because that's what I'm getting my larger bias from. But if you're going to, be very nimble and scalpy, then yeah, you can use the 9 MA on a 2 minute chart, 1 minute chart, etc., and so forth, right? And again, everyone's got their own version of these guys. I've seen people use 8 MAs. I've seen people use 21 MAs. I mean, look, use what you feel comfortable with. But the one moving average that you'll notice is pretty much consistent across the board is the 200. It very rarely we see, like, yeah, I use the 190 period moving. I use the 204. No. When you talk about institutions, hedge funds, etc., intraday traders, swing core traders, the 200 is the one kind of de facto moving average that most people use for the 60 daily, weekly, and monthly charts. When you get to the 9 and the 20, even the 50, I know people that use the 40 instead of the 50. I know people, like I said, they use the 15 or the 20 instead. You know what I mean? So that's up to you. We use these 4 here, though. All right. How moving averages can be applied. There's really kind of 5 ways that we look to apply these things, right? Guideline for trends, right? Most of the time, once you've gained a certain level of experience, you can kind of tell, hey, that stock's in a nice clean uptrend or a nice controlled downtrend, etc. But, the moving average can help determine that. We also use moving averages as areas of support and resistance. Now, remember, they're not actual support and resistance. We're using them as contributors to support and resistance, like a pattern booster, usually only applied when other concepts are converging in the same area, right? And that's the key here. And you're going to notice that with all aspects of trading, we never do anything by itself in a vacuum, right? We always try to get as many things lined up in a row before we jump in the water, right? So give that some thought when I'm talking about moving averages and trend lines. It's not the only thing we're looking at, right? It's one of several things that we're looking at, okay? Next, moving averages as target areas. Think about climactics. We often use the moving average as a area for a target, or a 50% retracement or something like that. Next, moving average as trade entry confirmation areas. Like what? Well, when you think about a consolidation back towards the moving average, and guys, don't worry, you're going to see examples of every one of these bullet points. I'm not just going to give you the text and go, oh, imagine it in your head. There are examples of all of them, but imagine a breakout moving back towards the moving average. Now we know it's ready to break out when it gets close to the moving average. Imagine a buy setup that pulls back down to the rising moving average. Now you know it's getting ready to trigger, right? So those are areas where we can use the moving average to help confirm our entry points, okay? And then, of course, moving averages expansion, meaning when to stay away because the moving average is too far away. The stock is too extended to jump on board, and vice versa. Because it's so extended and far from the moving average, that might be a reversal point. And this one is one where you see Unmall, Cass, maybe Aaron, a lot of people, using it so effectively with trend lines specifically, but occasional moving averages, but where it's a reversal point. Like, hey, this is a quick little, 3-minute scalp, 5-minute scalp for 50 cents, 30 cents, right? Something like that. But it doesn't just have to be used for scalps, okay? And again, there will be examples of every single one of these. So by the time we're done the lecture, you'll see each one of these. But these are the 5 main talking points, the 5 main reasons that we use moving averages and how we apply them, okay? So here's the first one here, okay? Multiple concepts converging in an area, okay? So if we take a look at this chart, we have a few things on here, right? We have a rising 20-period moving average. We have a trend line on here. The trend line is in this orangish color, and the moving average is in blue. And you look at it in the stock all the way on the left, okay? Kind of gaps up and moves higher, pulls back to kind of that opening price point, moves up, goes sideways, right? If you take a look at when it goes sideways, it's going back towards the moving average, goes higher, gets a little far away from the moving average, goes back towards the moving average, moves higher, again, gets far away from the moving average, pulls back towards the moving average, gets far away from the, you see the trend. But this is a nice, clean, controlled uptrend. This is exactly what you want to see. So when you're looking at buy setups and breakouts, almost every time it gets near the moving average is when it bounces again. And when it gets far from the moving average, it pulls back again. All right. Now, again, this is much easier on this chart because it's very clean and controlled. Also, you'll notice there happens to be this orange trend line very similar to the moving average, right? Not exactly perfect, but very close. So these are going to be areas that you can look to say, this is a buy point because I'm near the moving average. This is a possible sell point because I'm far away from the moving average and far away from the trend line. And then you're going to throw in other concepts. The other concepts would be, for example, on the right side here, 50% retracement. You might get a bottoming tail. You might get a change of color bar, right? You might get all these other things that come together. And remember, it's never just one thing. We're always looking for 3, 4, 5 things to come together because the more things that come together, the more reliable the trade is. And that's exactly what we're looking for, okay? So this is just an example of where a moving average and a trend line come together in areas and, in my opinion, make it obvious buy points. So we'll see that here on the next slide, right? I took the trend line off, but you get the point. We take a look on the towards the right-hand side. This is a buy setup, and it's a nice, pretty clean buy setup, right? Red bar, red bar, red bar, red bar, 5 red bars, pretty sequential move down, not a lot of overlap. Where are you? You're at the rising moving average. You're near the trend line. You're at minor price support. You're on roughly a 50% retracement. this is a pretty good play, right? So this is more traditional. This isn't like an unmall type scalp trade. This is a more traditional buy setup that just happens to be better because it's at a moving average, at a trend line, at a 50% retracement. And for those of you who have taken professional trading strategies, you know that for me, the location items are the most important. And we have three main location items. We have the moving average, we have the retracement level, 50%, 100%, 25%, and then we have minor price support, minor price resistance. You could add a fourth, which is the trend line. In this case, you have all four. If you can get the location items, that's more important than the bottoming tail or the change of color bar or the volume spike. Now, they're all important, so don't think I'm disregarding those. They're all important. But those location items, where it's happening, for me, are the most important areas, most important parts of the trade. Okay, so this one is a great example of looking at trends, right? We talked about that a couple slides ago, the 5 areas, the 5 reasons that we use moving averages. And this is 1, to show a trend, and 2, to show entry points. Okay, now another area we talked about is moving averages as support or resistance. A lot of times, and you guys see this in the morning when we go over the gap list, we're looking at the daily chart, the 60-minute chart, and we're looking at 50 and 200 period moving averages. Well, the one you're looking at right here happens to be a 200 period moving average, okay? And the stock is gapping right to it, right? We can all agree that there is room for this stock to drop, right? I mean, if you're gapping under this $100 mark, there's room down to 95. But it's gapping right to a rising 200 period moving average. So the long-term trend of this stock is higher. Now, I understand when you're looking at this chart, this picture, this slide, it's a choppy sideways trend between 100 and 110, 115. I get that. But the 200 period moving average, which is 200 periods for this stock, is trending up. So it's largely been in an uptrend. Maybe it's transitioning now. But if I see a gap right into the 200, man, it certainly takes a lot of the luster, right? It takes a lot of the sheen off the trade for me. Like, well, the 200 period moving average is usually well respected. And when a stock is sitting on one, it's not that it won't break through it. It's that it usually takes time to break through it. It's rare. It happens. Of course it happens. But it's rare they just hit it, break right through it, and just keep on going like it never existed. They usually fight a bit of a battle, a tug of war around that 200 MA, and you have to respect it. So while when you look at the chart, there's actually no real support here. There's a little bit of junk to the left, right? A couple bottoming tails, but there's no real support here. The 200 acts as support. And for me, I respect that. So I likely won't take this stock short. But what might be able to do? That's good English. What might we be able to do? Maybe we take this bouncing off the moving average, going higher for a scalp long, depending on how it reaches the moving average, depending on market conditions, depending on the lower time frame pattern. Maybe it's a double bottom retest on the 2-minute right at the daily 200. And the 2-minute showing a volume spike. I really want you guys to visualize what I just said. Stop for a moment. Visualize it. We have a stock that's right on the daily 200. Now visualize 5, 6, 7 bar pullback on the 2-minute. Right down to that daily 200. With a bottoming tail. With a volume spike. With a market that's going to bounce. That's a scalp long. Even though this is a gap down. So I'm using the higher time frame in the 200 as an area of support to possibly just take 50 cents. UAL, something like this we talked about today, right? And that's how you're going to apply these things, okay? Like I said, and I'll say it again, we never just trade in a vacuum. Like, we're just not ever going to do that, right? And you shouldn't do that, all right? Here's another example. Here's a stock that's largely been in an uptrend, 50 MA here, and then it's starting to roll over here, etc. Okay, and then it gaps down under a bottoming tail. But what happened when it touched the 200 MA or got close to the 200 MA, it left the bottoming tail. So this is pretty much exactly what I'm talking about, right? Gapping at or near the 200 MA, especially on the daily chart, can often act like a significant support area. So I may look at this and drill down to a 1, 2, 5 minute chart and go, all right, give me 50 cents. I'll take it, right? Give me 30 cents. I'll take it if I can find a pattern on that time frame, because I know there's going to be a reaction at the 200. How much of a reaction? I'm not so sure. But a lot of that will also depend on how it got there, what the market conditions are, what it's doing on the lower time frame, right? But you can see this stock clearly bounced 50%. If this entire day's range is $2, it bounced $1, right? I don't know exactly how much it bounced, but the red line is at 106.99. And where the close of the bar is 107.85. So it bounced 86 cents. Okay, that's scalpable. Nothing wrong with that. Okay. Here is moving average as targets, right? We see these on climactics quite a bit, right? Moving averages as targets. So when we get far enough away from a moving average, in this case, a declining 20-period moving average, you start going, wow. This one looks like it's probably going to bounce because it's accelerating away from the moving average. So it's doing two things. It's helping me determine that this is a proper climactic. There's other things, right? Like super wide range bars, volume spikes. But one of the things we look at is distance from the moving average. So it's helping me determine whether or not this is a quality climactic setup. It's also helping me determine where the target might be. And we talk about the two target areas for climactics as, well, there's three technically, as 50% retracements at or near the declining moving average, right? When it bounces back to the moving average, or a potential minor price resistance area. Those are the three target points. In this case, that's the first target, the declining moving average. But we also see a nice bottoming tail on volume after super wide range bars. So this moving average is helping me get into the trade and helping me get out of the trade. Beautiful. It's done two things for me. Got me in or helped me get in, and it's helping me get out. Okay? So, good stuff, right, with the moving averages. Market is rolling over here pretty good. All right. Here's another example. Rising 20-period moving average with multiple time frames. Now, this piggybacks off what we just talked about. The last slide, right, that was an intraday climactic. But now, what do we have? Now we have a daily climactic, right? We have a double top right here, double top on the daily. And then the stock goes 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 bars down. And it continues to accelerate away from the moving average daily climactic. So within this daily climactic, I know over the next 1, 2, 3 days, there should be some level of bounce, right? There should be. So I'm using this on multiple time frames. I'm taking the distance from the moving average on the daily climactic, and I'm going to apply it to the next 2 or 3 day bounce. And then there it is. So now if I look at the lower time frame chart, the 15-minute chart, okay, it gaps up slightly, moves above resistance to the left, pulls back to the moving average, pulls back to minor price support, right? What used to be the ceiling at $86 becomes the floor once I break through the ceiling, right? So it used to be the ceiling, 86, 87. It's now the floor. So now I'm using the moving average as a buy point based off of a daily climactic. I mean, this is the way you do it. This is the way you trade, okay? And there's other things here. There's a bottoming tail here. There's a change of color bar here. There's probably a trend line here. There's a lot of goodness here. But I'm not just looking at it on a 15, and I'm not just looking at it on a daily. I'm trying to put them together to give me the highest odds possible. And this stock ends up going from, 87.25 all the way up to like $89.32. Okay? That's how you do it. That's how you get it done. Now, different type of pattern, but using the moving average as confirmation of an entry or confirmation for an entry. So this is using the moving average as a breakout confirmation. Okay, so chop, 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 not doing much, not doing much. It goes higher. Now there are two areas here. Let's do this because I didn't put the arrow there. There's another one, right? Okay, so now we have stock chopping around, then it consolidates back towards the moving average and then breaks out. But after it breaks out, what happens? See the distance here? Like a $3, $4, $5 distance here. Stock needs some time. It's a little tired. Just ran a marathon, just went up 1, 2, 3, 4, 5, 6 bars in a row. It's like it's a little tired. So what's it do? It consolidates. But how do you know it's not ready right here? Right there where my cursor is on that red bar. Well, you know it's not ready right there because it's still too far away from the moving average. So you take a look at this red bar and you're like, well, it's rested 4 bars. How do I know it's not ready? Because of the distance from the MA. It's too far. And then it continues to consolidate. And what's it do? It continues to close the distance from the moving average. Again, it doesn't have to touch it. Just like professional trading strategy says, a 70% move back towards the moving average is likely enough. It doesn't have to touch it, but it has to get close to it. It has to cut that gap down, cut that distance down. Okay? The more it cuts the distance down, the more the stock has rested. All right? And then when it gets back towards the moving average, in this case, it happens to touch it and then rip. I mean, rip from 600 to like 608. And this is an intraday chart. So it was like a 2-minute chart, something like that, right? Hello, right? Big deal. So this is, again, using the moving average as a confirmation that the stock is ready to be bought. And in this case, it's a breakout, right? Here's another example. This one is what? It's a breakout and a buy setup, or a buy setup and a breakout. So now we have a stock that's clearly in an uptrend, okay? It has a wide range green bar, pulls back to the moving average, pulls back to minor price resistance, minor price support, my apologies, okay? Triggers, goes higher. Then what happens? As it bounces, it gets far away from the moving average again. So I know it's not ready 4 bars, 5 bars later because it's still far from the moving average. And the danger is if it triggers after this 4th or 5th bar, this consolidation bar, if it triggers, it may be a false breakout because it hasn't rested long enough. So when it gets back towards the moving, again, it doesn't have to touch it. These are really good examples. It doesn't have to touch it, okay? But it has to get near it. And when it gets near it and it breaks out, most of the time it'll be a quality breakout. Again, look at the higher time frame, look at how it breaks out on volume, lack of volume, market conditions, etc. There's other things to consider. But this is a big deal when they get close to the moving average. And the further away from the moving average they are, the less they've rested, the more tired they are, and the more likely they'll fail. Okay? So use it as a guide. And again, this is another example of a stock that, man, if you were to put a trend line on this thing, it would be pretty much right where those areas are. In fact, let's go take this for a second. Let's just put that on it. Let's just try it. Take this down here, draw this here. Okay, we're cutting through a little price there, but we're pretty close, right, on our trend line. I mean, we're pretty close on that thing. So my point is, it's not just a moving average, it's near the trend line, okay? So there's other things to consider, but the moving average is important. So now, this one's kind of interesting. Moving average and trend line flags. You ever wonder sometimes when you see Aaron or you see Unmal, or you see Cass, you see Cliff, you see Stefan, especially when you see Cass or Unmal, and Aaron does a great job as well, I think, at this. And you're like, why there? Why'd they short it there? Why'd they buy it there? You got to look at both the up and the down trend line, right? There's 2 trend lines on every chart, really, right? The up trend line, down trend line. And In this case, you're looking at the moving average, right? One, let's take a look at the left first. Let's start there first. We get really far from this blue line, like really far from it. This is a shortable opportunity. You're really far from the moving average, okay? Once it pulls back to the moving average, it bounces, but it puts in a lower high. But then it puts in a higher low. But then it puts in a lower high. But then it puts in a higher low. And then you're getting what? You're getting this flag wedge. These are buy and sell points. Okay? When you're looking at this, you're looking at buy points and sell points and buy points and sell points. And then you get the ultimate buy point over here, and this thing continues higher. Okay? It's just, when you start looking at these things in this way, it's like Neo in the Matrix. I'm not trying to exaggerate, but clarity just happens. Okay? In the beginning, you're kind of a little bit confused at what you're looking at. And then the more charts you see and the more trend lines you draw and the more moving averages you see, the clarity, it just crystallizes for you. And this is just a truly phenomenal buy area, especially over here, right, as these two lines converge, right? And you can look at the moving average as well rested because it went sideways for a while. It's not like straight up like it is here, really far from the price action. It's right at the price action. You have that lower high, but the higher low, and then a lower high and a higher. And there's opportunity inside of this flag wedge. And then there's opportunity at the end of this. Use the opportunity, okay? If you're not sure about shorting it over here, then don't. Wait till the flag forms. And if the flag never forms, then you move on. And if it does, you take it. And this is an idea, a concept that I need you guys to really understand. Patience. You are going into a stock and you are saying, this is what I would like to see happen. If I see that happen, I will take it. If for some reason that does not happen, I won't force the trade. I'll move on from it. And this is an idea that I think is really challenging for a lot of traders. Demanding what you want and not giving into it. It's like, I don't know, you're going to buy something or sell something, whatever, and you're like, I will not sell this car for less than $50,000. Somebody offers you $40,000 and you take it. Like, well, what happened to your $50,000 that you're demanding? Don't give into it. So what I'm saying to you is, and you'll see Unmall do it, I do it, I'd like to see this happen. You'll hear us say it. Man, wouldn't it be really great? Okay, here, perfect example. Perfect. Just popped in my head. AMD yesterday. Pre-market, I said I'd really like to see this go to 113 and give a sell setup. Right? Those were the words at 9:25 in the morning. If it doesn't do that, oh well, that's fine. We just probably won't trade it. But if it does do that, we will probably trade it. And don't change. Right? It's like, I don't know, you're in the dating scene, you have a list of like deal breakers. For example, I could never, will never, have never dated somebody that smokes. I can't stand it. It's nasty. I'm not giving that up for somebody. That's it. That's like, it's a deal breaker. It's a hard line in the sand for me. When you're trading, you need to have a hard line in the sand that says, this is what I need to have happen for this stock. If it doesn't, I won't trade it. Too many of you are just tilting your head or getting bored or I got to get my money back. And then you just jump into something that's really not that good. Demand it. Don't ask for it. Demand it. And if the stock isn't willing to perform or give that to you, guess what? Next, there's more fish in the sea. There's more stocks in the market. Demand it. Demand it. I've said it like 12 times now. The next time you catch yourself doing something like that, step back and go, whoa, this is crossing my line in the sand. And I don't do that, right? That's it. Okay? So, over here, what do we have? Stock on the left, it's moving up. Moving average is here. Trend line is here. And what happens? Get a little mini breakout, right? Little mini breakout. Right there. Far away from the moving average, far away from the trend line. depending on what the higher time frame looks like, okay, and this is a daily chart, you're looking at sell opportunities here. You're up 1, 2, 3, 4, 5 bars the next few days. You're looking for sell points on lower time frames. So some of you will get into a trade with Unwall and Meta and be like, dude, this thing's freaking strong. Look at the daily. Went from 100 to 307. What are you doing? And the guy makes money on it 95% of the time. And it looks like you guys probably just got out of Meta, for a profit or whatever it is. But my point I'm making is I'm almost looking at these daily, weekly, monthly charts as well as the 1 and 2 minute charts and going, gosh, this stock's up 5 days. 2 of the days are wide range days. It's going to pull back towards the trend line. It's going to pull back towards the moving average. I'm going to have some opportunity here the next couple of few days. I'm going to watch this thing very closely over the next 2-3 days. Why? Because there's a real good chance it's going to, the magnet of the trend line, it's like a tractor beam. It's going to pull it back in, right? You need to be thinking like that. Instead of just going, oh yeah, look how strong that stock is. No, and understand it's going to have a pullback at some point, and you want to be there to pounce on the pullback, right? Then the stock chops around, and what do you get here? A little break of support right there at 44.50 right there. Another opportunity to short this stock down into here, okay? Now all of a sudden, you're starting to draw the trend line on top of the chart, right? Let me explain. Let me do this. So now you're starting to look up into here and go, oh, interesting. Now I can start looking at sell points, right? Look at this topping tail right into the trend line, sell point. Look at this pivot right into the trend line, sell point. Look at this double top and sell point, okay? These are areas that you can take advantage of. So you can make money on this stock in just about any environment. Not every day, but in almost any market environment, okay? So those are things that you really need to kind of give some thought to when you're looking at trend line and moving averages, et cetera, and so forth. Now, let's change gears a little bit and talk about moving average separation. Great job, Oswald. Well done, man. Let's be fair, the Meta got a little nip and tuck there, but well done. The guy's amazing. He just finds a way. All right. So let's talk about the separation here. So now we have a stock that is what? Going lower, right? Stock dropped, bounced, dropped. And just take a look. It got really far from the moving average over here. Then it bounced and dropped. It got really far from the moving average over here. Now let's do this too. Okay. Let's put this on here. Just draw that there. Hold on. Let's make it a different color. All right. Okay. See that? That's trend line. That's a downtrend line. That's the moving average. That's the pivot. We have a problem here. Right? Will Rogers, we have a problem. We're far from the moving average. It's going to bounce. We're far from the moving average. But now what do we have at the bottom? This is a warning sign. Okay, and there's a few things you need to look at here. You need to look at one, we're far from the moving average, and we're consolidating back toward it. Now, a new trader, a novice trader, is going to look at this. And they're going to go, this is right out of the textbook. Just what Jared said. Oh my gosh, it's consolidating back to the moving average, is ready to drop. Not so fast. Not so fast. And this is where, before I get into the details, where there's so much to learn in trading, right? We can look at something very basically and go, oh, it's consolidating back to the moving average. Jared said that's the buy point. And that's true sometimes. And then we're always looking for multiple concepts converging, right? We're always looking for multiple concepts converging. Now, once you start doing more research, more homework, digging deeper, you realize this is the exact opposite of what I was thinking. This isn't a short, this is actually a long, right? So you take a look at it and you're like, okay, we're consolidating back, but look at the 200 and look at the 50 here. I think it's actually a 20. Look at the 220. Look how far away they are. There's a major divergence distance between the 200 and the 20 here. We're far from the moving average. You get a peekaboo breakdown and then big time volume. And it doesn't go lower. The volume spike here is like the final straw that lets you know, hey man, I think I'm going to go long here. And then you go long here, okay? And the new trader is lost. They're lost in space. Like, what are you doing? You don't, you're a hypocrite. You don't do what you say. You don't do what the textbook says. No, we do. But you're only looking at one aspect of this trade. And the aspect you're looking at is this stock going back to this moving average. You're not looking at the distance between the 200 MA and the 20 MA. The divergence here, the acceleration here. See this blue line dropping? There's an acceleration here. Okay, and that's not what you want to see. Okay, anytime we see an acceleration, there's usually a magnet that draws it back. We also have a trend line here. It peekaboos lower, doesn't go lower, puts in a huge volume spike for this stock, and then you know what's going to happen tomorrow. Stock's going to bounce. Whether you choose to go long on this, that's up to you. But you're definitely not going short on it. I don't care if you don't buy the stock long. That's fine. But don't short it either. Let me repeat it one more time because I know it takes a while sometimes. I don't care if you don't go long on it. That's up to you. But please do not short it. Okay? This divergence is just too much. Okay? Now, what do we have here? Oh my gosh, it's deja vu. Let's do this again. Roll this again. Right about there. Let's give it some orange. Okay. Same situation. Stock that was in an uptrend drops, gets far from the moving average, consolidates back to it, drops, consolidates back to it, big time drop, huge divergence from the event, consolidates back to it. But look at the distance. Look at the acceleration between the 200 and the 20. Big time acceleration here. Bottoming tails, volume spikes without lower price. Do you guys remember when we talk about breakouts and breakdowns? We talk about two things. We talk about price tells us what is happening, and volume tells us how it's happening, right? So you can have a stock, and we talk about, for example, a breakout on volume with little to no price movement is a warning sign, right? That's what you're getting here. A breakdown on huge volume with little to no price movement is a problem. It's a warning sign. Now you're also getting a little bit of a double bottom. You've had a bottoming tail here. You're far from here. Stock's likely going to bounce. And like I said on the last slide, don't really care if you don't buy it. A high-level, experienced professional trader would likely go long here. But if you don't want to go long, that's fine. Just don't go short, right? Missed money is better than lost money. So just don't go short, okay? But good traders probably going to go long here, all right? So these are things that you need to understand. And again, I want to go back to what I said. The new trader is simply just going to look at one thing because they trade in a vacuum. And they're going to, well, you said if it goes back to the moving average, then it's shortable or buyable. Now you're telling me it's not. No, it still is in a different circumstance, but just not this circumstance. And that's the nuance of trading that new people don't get, right? So this is why we try to have these lectures so we can explain these things to you. So at least you'll have this to go back and lean on and hopefully start to recognize in real time. You'll make some mistakes, and that's fine. That's part of the process. I made a mistake on Amazon today. It's part of the process, right? But you have to put all the information together, all right? Here's another example. Moving average as support with confirmation. So over here, oh, this is yesterday, isn't it? Yes, it is. Look at that. I forget what I did yesterday. All right, so this is yesterday, okay? We have a daily chart here on the left and a 5-minute chart on the right, okay? This stock is right at the rising 50-period moving average. You can see it right here. I blew it up for you, right? Blew it up right there. And it's been doing a pretty good job of holding, right? The day before yesterday was a big bottoming tail. Yesterday was a doji bar. And you're noticing this thing drops, bounces, drops, and puts in a bottoming tail on volume right at 109.50 to 110. Well, where's that moving average again? Oh my gosh, it's at 110. Where's the bottoming tail from the previous day? It's at 110. So we have the previous day's bottoming tail, we have the rising 50-period moving average, and then we have a double bottom retest. Now remember, I'm not marrying the stock. I'm not asking the stock to go back to 113.50. I'm simply saying, give me 50 cents to $1, and I'll thank you for it, and I'll move on. So if I'm going to be looking to get in at 110, you give me 110.50 to 111, and I'll be happy with you. All right? And this one made you work a little bit. It went to 110.80, chopped around, and then ultimately went to 111.50. Okay? But this is a good chance that this bottoming tail has set the low of the day, especially on volume, especially where the moving average is, and especially given the bottoming tail from the previous day. Now, is this a little bit challenging of a trade? It is. It's a little bit tough. But if you're nimble and your expectation is reasonable, this isn't a bad trade, right? If your expectation is 4R, I probably wouldn't take it. Your expectation is 50 cents. There's a good chance you're going to get that out of it, right? 110 entry, 109 stop. Hey, take the half R, take the 1R, something like that. Could you use 109.50? Sure, you could if you wanted to. That bottoming tail shouldn't be broken. Maybe give it an extra 10 or 20 cents and you have a 60 or 70 cent stop and you get 1R, move on. Based off the daily chart. Bottoming tail, rising moving average. Okay? Adobe. You guys remember Adobe from yesterday? Some people thought I was like, my head was messed up. Well, I'm looking at the 15 and the 3. Okay? I'm looking at the trend line on the 15-minute on the right-hand side. I'm looking at the rising moving average, and I am looking at this green line at 490. All right, can you guys see this green? Maybe I should make it pink. There, a little easier to see. Okay, so now this pink line is an area of de facto support. I know this because I can see over here, 490 here, 490 here. This used to be resistance. The ceiling becomes the floor. One more time, the ceiling on the left becomes the floor. Okay? Pops up, pulls back. All right? Bounces, pulls back, bounces. In fact, it has a little bit of a wedge. Yes? Has a little bit of a wedge. Higher lows, lower highs. The next day, early on, pulls back. This 15-minute red bar, drill down. There it is. 2 minute, 2 minute, 2 minute, okay? Pulls back, pulls back, pulls back. Oh my gosh, 492. Well, 490, 492 area, that's the support area. That's the range, okay? That's the range, okay? You look at it, it doesn't go once, it goes twice. It retests this area around 10 o'clock. I mentioned it then. I mentioned it 17 times yesterday. I'm not asking this thing to go back to the high of the day. I just need 496 out of it. You're going to get in it. Remember I said buy it between 492 and 493? Okay? I don't know if you do remember that, but I said it like 5 times yesterday. Buy it between 492 and 493. Put your stop down here at 491, maybe 490, something like that. Shoot for 496. Those are the exact words yesterday. Okay? Shoot for 496. Well, it went to 503. That's unexpected. But I didn't need that. Didn't care if it went there. That's great that it did. But this is the area. Based off of the 15-minute trend line, based off of the 15-minute 50-period moving average, and based off this support area. So some people are looking at this trade and they're tilting their head like, what are you doing, man? And I'm looking at it going, I'm really looking forward to trading this thing, right? So this is multiple concepts converging in an area. All right? Know the expectation. Yes, it's in an uptrend in the 15-minute chart, but I wasn't really expecting a new high of the day. It's great that it did, but if you can get $2 or $3 out of this thing with a $2 or $3 stop loss, great. Take your $1, $2, $3, walk away, move on next. Okay? So back to what we use moving average and trend lines for. Guidelines for trends, areas of support and resistance, target areas, moving averages as trade entry confirmation, and then, of course, moving average expansion. When we see them moving away from each other, it can be a warning sign not to go in that direction of the moving average. Okay? And I gave examples of each one of these, usually 2 examples of each one of these things. And I want you guys to kind of just really start digging deep. And I don't expect you after this lecture, if you're newer, to just get it all, right? It's a lot of information to take in. But moving averages and trend lines can be very potent and powerful. And you're seeing some amazing traders in this chat room use them every single day. And they're right 80 to 90% of the time. Okay? You see Unwall come in, he's 3 for 3 on Meta today. Right? You see Jeff come in, ATVI today. You see Aaron come in, do this every day. You see Cass come in, do this every day. You see Stefan do it every day. I mean, Stefan made like 8R yesterday. Okay? He got 2 4R winners yesterday. Right? Or was it Amazon and JP Morgan or something like that? Wow. It's insane. Okay? Using these types of concepts. All right? Using these types of concepts. So, moving averages are not actual areas of support or resistance. Only price can be actual, but they can be very useful. Use them as guides. Use trend lines as guides. Okay? So, I hope you guys learned a bit about how to more effectively use moving averages and trend lines in not one instance or one scenario, but in multiple scenarios. We gave 5 different areas to effectively use moving averages and trend lines. And I hope that you'll apply some of these. You don't necessarily have to have every tool in your toolbox when you're new, right? You're going to slowly build the toolbox over time. I don't expect after 40 minutes today, after this, you're going to perfectly apply these. But you can start trying to apply them today or tomorrow and then eventually get better and better and better at them. And I'm telling you, when you see somebody that you respect in the chat room take a trade, take a picture of it. Even if you don't take the trade, take a screenshot of the entry they said and the stop they used, and then later on go back and dissect that trade. And I bet you're going to find a trend line in there somewhere or a moving average or something like that. All right, so I hope that you guys learned a little bit more about trend lines and moving averages. I hope you'll use this to be better traders and hopefully make more money. I'm Jared Wesley of Live Traders. We'll get back at it again next week.